Hi, I'm Vern Bell. In this short video, I'm going to introduce you to our weekly situation report, or SITREP. The first part of our SITREP consists of a free market timing signal for long-term investors, which we call the bull-bear indicator. The second part of our weekly SITREP consists of a fairly detailed market overview, titled In the Markets. This overview consists of the major happenings, both U.S. and global, and commentary. If you haven't been glued to the finance channels lately, you may want to take a few minutes to browse the content. In the remainder of this short video, I'm going to introduce you to the bull-bear indicator in greater detail. To access our SITREP, simply go to our home page and click on Weekly Update, or key in our URL plus /blog as shown here. The first thing you'll notice when you access our weekly update webpage is our bull-bear market indicator in the far right column. A bull image denotes a bull or upward trending market going forward. A bear in the far right column denotes a bear or downward trending market going forward. Once you become familiar with our bull-bear technical model, if you decide to incorporate our bull-bear signal in your personal investing strategy, this may be all you need to know. To access the full SITREP content, just click on Continue Reading here. In the balance of this short video, I'm going to discuss how the bull-bear indicator works and what makes it uniquely valuable to the long-term investor. Here's a chart of the S&P 500 since 2001. I captured this image off Yahoo Finance. The last major downturn we experienced was in 2008 and 2009, when the Standard & Poor's 500 index lost around 1/2 its value. Today we call this period of time the Great Recession. This term, of course, harkens back to the Great Depression, in which investors lost 90% of their assets and unemployment was 25%. For many of us, the Great Recession was a true learning experience, however unwelcome. During this period, we learned new terms like too big to fail and credit default swap. It took around 6 years for the index to recover. Of course, this could never happen again with all the great protections the regulators in our legislature have put in place. Sure it can't. Prior to the Great Recession, the dot-com crash, or dot-bomb as I like to call it, lasted from sometime in the year 2000 to around 2004. This time recovery would take 8 years, and of course it could never happen again, yada yada yada. Notwithstanding the relatively minor 2011 correction, we've had a relatively smooth ride over the past decade. That is, until recently. Over the past 18 months or so, volatility has re-entered the markets in a big way. There are major forces at play that suggest that something big and very negative is coming, and probably coming soon. I'm going to list a few issues of major concern. If you want to know more, I suggest you write them down and do some additional research. Pause the video if you need to. The cyclically adjusted price-to-earnings ratio, or CAPE, is close to a multiple of 30. This is nearly double the average value. In short, this means that the value investors are placing on stocks when compared to the 100-year average is extremely high. In the past, this has been a reliable indicator of a pending correction. Please read the first part of the SITREP for a more thorough explanation of the CAPE and its implications. Recently, the yield curve inverted for the first time since the Great Recession, and stocks plummeted in response. An inverted yield curve is considered a classic recession signal. If you're not familiar with the inverted yield curve, just Google it, but be prepared, the news can be unnerving. Negative interest rates. I'm surprised how many people outside of the financial services industry haven't heard of this, and most financial pros don't really understand what's going on. Imagine a bank that pays negative interest. In this upside-down world, borrowers get paid and savers are penalized. Crazy as it sounds, several of Europe's central banks cut interest rates below zero in 2014. And then Japan followed. By mid-2016, some 500 million people in a quarter of the world's economies were living with rates in the red. Unthinkable before the 2008 financial crisis, the idea is to jolt lending, spur inflation, and reinvigorate the economy after other options are exhausted. It's an unorthodox move that has distorted financial markets and triggered complaints that the strategy is backfiring. Nevertheless, recently I heard discussions of negative interest rates in the U.S. Personally, I think it's pure insanity, and perhaps the scariest of all the many factors that suggest we're close to at least a major recession, if not a depression. Okay, so let's take a look at the same time frame with the bull-bear periods overlaid in light blue. These are the periods of time when allocation to less risky assets would have been appropriate. As you can see from the chart, the bull-bear indicator signaled caution from the end of year 2000 through the first quarter of 2003, thereby reducing possible losses during that period. Again in 2008 and 2009, the bull-bear signaled caution, as it did briefly in 2011 and 2016, all with considerable potential for loss. One of the greatest problems with this kind of model is known as whipsaws. I've experimented with many other models only to be disappointed by the losses attributable to whipsaws. While the bull-bear is not always dead on, there are very few and minor whipsaws. If you want to learn more about the effect whipsaws can have on a trading strategy, just Google finance whipsaws. Here's the same period of time with the bull-bear calculation charted. Here you can see the specific days that the bull-bear triggered bull or triggered bear. It's important to note that while most of the above transitions took place on Fridays, the bull-bear can trigger positive or negative any day of the week. At Texas Lead Advisory, we monitor the bull-bear indicator daily. This puts us in an excellent position to act on behalf of our clients should a major correction be indicated. Each of our clients has a separately managed account. Our clients grant us discretionary authority to trade their accounts on their behalf. We're paid a percentage of assets under management, which means our interests and our clients' interests are aligned. We earn more as your account grows. We are not paid commissions on trades, and we do not accept back-end compensation. We exercise our best judgment in combination with the bull-bear indicator to maximize our clients' returns. In addition, as a registered investment advisory, we are fiduciaries, which means we must put our clients' interests ahead of our own. Well, hopefully this has been enough information to get you started. If you have questions or want to chat about setting up a managed account, please call us at 972-437-8960. Good luck with your investments, and remember the first rule of investing: don't lose money. And please take a few moments to read the important information on the following slide. This is Vern Bell. Bye for now.